All right, welcome to the Closing Beat special edition here out of the old household. If you've never seen our Jazz After Dark, this is where I do it from, actually in my house at night in the dark. Anyways, we're going to cover the stock market here today. I thank you for following along and joining us for the day. We're going to have a lot of interesting things to talk about. We're financial advisors. They can actually talk about the stock market. So if your advisor can't or doesn't know how it works or just seems to never mention anything that doesn't seem more than just a cookie cutter advice there, hope you'll check us out. Before we get started, let's look into last week, the jobs number. Holy cow. Now, we don't do the show on Friday, so I wasn't around for this, but 517,000 jobs versus like 180 something thousand expected. And so the market saw a little bit of weakness, which the headlines attributed to that. Really, so far, outside of tech, the jobs market's actually pretty strong. That's not good if you like following along what the Fed's doing. I'd also add that the average hourly earnings didn't really budge. So that's kind of good news there. But the thought is that the Fed, although they're kind of claiming victory and saying, yeah, we sort of got this disinflation happening at the moment, they're likely going to have to continue holding rates strong in order to slow inflation. And also, inflation may not slow as fast, right? So the pace of declining inflation could be a little bit persistent, as they would probably say there. I'll maintain soft landing, and I'll go into some other examples to help explain that here for you. But again, inflation may be falling, but it may start falling at a slower pace there, at least with the latest data that we had. Also, unemployment, 3.4%. Does anybody see that? I've never seen it that low in my lifetime, actually. So there's probably a lot of you that haven't seen it that low in your lifetime. It's officially the lowest level in my lifetime. You actually got to go back to the 68, 69, somewhere in there, if you want to look up the data there. Now, the headlines focused on the jobs numbers, but you can't ignore the fact that the S&P is actually extremely overbought here. So I'm going to bounce over, try to take a look at the markets here in a unique way so that we can actually do this here. Let's see what happens when I do that. There you go. In the short term, we're, of course, very much overbought there. Really led by a handful of names. I'll talk about that in a second. But the big picture here is we're working our way out of a downtrend. We spent a year in this freaking downtrend here, and now we're finally breaking above it in a convincing way. Remember, this was sort of a fake out there, one-day fake out. But now we have a series of higher lows and higher highs, right? You can see them shaping in. So all I'm saying is right here in the real short term is a little bit overbought. And if you want to go back and actually look, I probably could pull it up for you. We talked about this on the Closing Beat last week, but this rally really just led by a couple names, actually 10 names to be exact. I'm going to pop over here and see if this loads, and it's not. So we'll come back over here until it finally does. But you have, Apple, Alphabet, things like that were helping lead the rally. Let's try it one more time. What is the problem here? Doesn't seem to want to pop up. Okay, we'll give it a second. And so in the short term, the rally being led by those 10 names that I shared last week, okay, that's not a broad market rally. I made a big point of this on Thursday. This is not what you consider a broad market rally. Now, broadly speaking, yeah, okay, we got a nice little rally. We got things actually shaping up, moving kind of in our favor here, as I was just sharing with you. So you can't really be too upset about that. But in the ultra short term, this is the one we're worried about. This was not a broad market rally here, right? So the headlines might have said, jobs numbers were super strong, everything was good. But in reality, we got just a little ahead of ourselves in that market rally. And that's really true for no matter where you want to look. If you want to look at the NASDAQ, not so much in the small cap, the Russell 2000, but you got some let's go over here, reload. But you have a little bit of extension there, right? So not so bad over there. I'm going to just pop over here and do it the old-fashioned way, since this doesn't want to load. And then we'll just go with that. Good enough, right? So good enough there. Here's the contributors there. So 50% of the rally came from the rest of the market. 49.49% of the market's rally came from these 10 names. And so in the short term, that's a little bit tough to digest. It's a little bit hard to like the market here. Broadly speaking, it's hard not to like the market, right? Now, there's some really interesting themes playing out. I'll just jump to it here since we can already see what's going on. Oh, I guess it's not connecting or something. Check out these themes playing out in the market. Now, what we did here is color-coded a sort of a decile analysis, and I'm going to go through it for you. So we're comparing 2022's revenue growth to so far this year's revenue growth stocks. So what we're saying is last year, the stocks with the lowest revenue growth are currently one of the best performers this year. Let's try it again. Look like it connected. Oh, it did it. Okay. Now it's bigger for you. There's the, holy cow. I mean, just do something for me here. It looked like it was going to connect, didn't it? And it wasn't going to do it. So we'll pop over here to that chart from a second ago. Oh, because it's reloading. Okay, we're doing things right here. We're doing it now. Here you go. So take a look at revenue growth. So I'll use this as my example. The stocks with the lowest revenue growth last year are currently year to date up 19.47%. The stocks with the second lowest revenue growth are currently up 18.5%. That's second place there so far year to date. And then over here, the stocks with the ultimate highest revenue growth are leading the way. It doesn't really tell us a whole lot, right? So revenue growth stocks, you're on both ends. You're either following that value revenue stock or you're following those that are strongly growing. You see the sales improving, everything is great. Take a look down here. From a technical perspective, stocks that were the most distant from their 200-day moving average are currently blowing away stocks that were trending above their 200-day moving average. Right? So stocks, these are just really, really discounted stocks. People want junk, right? And there was a saying, it's taking their cash and moving it to trash. That's how they used to say it. Another way we can verify that is up here. The ones that had the worst percentage change, the lowest gain in 2022, or in this case, we should say the biggest loss, currently in 2023 have the biggest gains. And, Carvana is a great example. You know the stocks we're talking about. So, and it's not just that they're picking on the cheap stuff. They're picking on anything that's relatively cheap, anything that's relatively discounted. We talked about this earlier in the year. Things that are right now expensive, the best performers, they're getting sold. The best performers in 2022 are getting sold, and in exchange, they're buying the cheap stuff there. Short interest, those with the highest short interest. There's your Carvana right there, right? Your Etsy's and all the stocks that have been beaten down and really, really highly shorted. Anything even close, the top 2 deciles actually performing like that. And so you can just kind of look and kind of see there. Those with the worst analyst ratings, they're getting picked up. Anything cheap and trashy, market cap being the lowest, just, these are small cap stocks. Anything like that, price to sales, right? Anything weak that otherwise you'd look at a chart and you'd say, I just don't know. Fundamentally, I don't know if I'm interested in a stock like that. That's pretty difficult to get my hands out on. And so that's something to take a look at going forward as well. Wanted to give you a little bit of a sort of a lesson in really analyzing the market in just a little box, right? To kind of see what's going on. I also want to point out we've had some great classes in our Wine and Wealth over the last couple of weeks. 2 weeks ago, we covered return on capital and went from anything from like using a CD money market account all the way up to selling options and portfolio margin, things like that, everything in between, houses and all that. So be sure to check that out if you're one of our clients. Every week I do a class for clients, me or Eric, and we try to focus in on a topic and just go deep. You know what I mean? Just talk about things that maybe on the surface, we just review it and then give you a little bit more. And of course, if you're a new client, last week, our class was for new clients, right? We did an orientation of sorts. How do you navigate everything and check things out? Now, one more thing. Let's go down to the sector level, and let's do this differently than anybody else probably would or any other advisor wouldn't even know how to do. Let's go a little deeper. If we look for the best performing sectors, we want to find like what's waking up, what's falling down. Some of it's obvious, some of it's not. But what we want to do is we want to compare it to the market. We don't just want to look at a bunch of charts that are showing these sectors. That's helpful, but not super helpful. We want super helpful. Remember, in 2023, we're going the extra level deep. So we don't just want to do the basics. We want to go one extra level and learn something a little deeper. So what I did is I took the individual sectors themselves and I made one chart, one line on a chart that shows its relative strength compared to the market. In other words, if what you're about to see, if the line is going up, it is outperforming the market. If the line is going down, it is underperforming the market. So now we'll be able to look at the individual sectors and not only be able to see what's weak, but what's weaker than the market, what's stronger than the market, or hanging in there, I guess. So here we go. Pay no attention to the title. That's not accurate. So I spent time on the charts, I guess. I put some green lines in here to show you. Consumer discretionary. We know that's a good sector so far this year. It's outperforming. It's showing more relative strength in the market. Tech, that's an obvious one, showing more relative strength in the market. Looking around, communication services, ever so slightly outperforming the market. So it is clear as mud, and that's not actually clear. So let's say it's clear as day, right? Where you should be looking if you like momentum, outperformance, things that currently have all the interest from other investors. If you're a contrarian like me, you're looking elsewhere and saying, holy cow, consumer staples. I thought we were going into a recession. More on that in a second. Healthcare. I thought we were going into a recession. That's a little bit weird. Utilities. I thought we were going into a recession. These sectors are underperforming the market at the moment, and kind of energy and industrials a little bit. But if you're a contrarian, you say, okay, I like that. I like the discount. Where's healthcare as a sector going? It's not going anywhere. We're not going to lose healthcare. So you say, well, okay, well, maybe I'll go search for some ideas there. No, I like momentum. Okay, I'll go to tech. Consumer discretionary. Maybe you don't chase them now, but you look for those performers. Everything else, real estate, it's okay. Materials, kind of choppy and sideways there. Financials, a little bit of weakness now, but otherwise chopping around trying to figure out what to do. And so real quickly, you can look at the entire 11 sectors in the market and figure out, who are you? What do you want to participate in? And like I said, it should be clear as day. Like wherever you like to participate, there is no excuse for not being in that area right now. Really, kind of easily to understand. Okay, soft landing. One of the last things I'll talk about today. Me and Eric have a bet that the economy is going to experience a soft landing or not. I'm going soft landing. Eric's going a little bit doom and gloom, like things are a little weaker than predicted out there. I will tell you either way, whatever you believe in, the stock market has priced in a soft landing. So if we have a soft landing, you do not expect the markets to just take off. They already are. If you expect doom and gloom, the market's already assuming that's not going to happen, right? So if we actually do get this soft landing, would we see dramatic upside performance in the market? Probably not, right? And one of the things I just showed with you, right? I just shared it to you. If we were going into a hard landing or a recessionary period that was going to be very weak, we would have stronger healthcare stocks. Money would be flowing into healthcare. Consumer staples, money would be flowing into consumer staples. Buy the stuff that's non-cyclical. Cyclicals, tech, communication services, consumer discretionary, they're outperforming defensives by 12 percentage points so far this year. That means people believe a sharp improvement in economic growth is going to happen. You wouldn't take that risk if you didn't believe so, or they wouldn't, right? We don't believe there's going to be a recession, at least because, well, people that are participating aren't pricing the markets that way. So we can expect that if a soft landing actually comes true, then we wouldn't actually expect a lot of upside in the market. It just wouldn't be expected, right? So we have that, meaning we've already priced everything in. And then one last thing, we have money leaving the market. We can actually track that. So money's leaving, the risk-averse money is leaving the market and going where? What finally has higher interest rates that it can go participate in. So here's an actual money flow chart. This is from Goldman Sachs. This one's not mine. Mutual fund money flows, and we're including ETFs in this as well. Year to date, where's money going? We've lost $7 billion from U.S. equity funds. Those are your ETFs and mutual funds that are focused on growth, right? Index funds, things like that. $7 billion left. Non-U.S. equity funds, international right now, believe it or not, doing really well. Our international fund is like oddly outperforming. It's not supposed to on a year-to-year basis, but so far it is. Bond funds. Hey, I can go over here, put $58 billion in bond funds. Where was that money before? It had no other choice. Remember, all of last year, it had nowhere else to go besides the stock market. It was the only place to get your yield on the S&P of like 1.7%. Now we're looking at bond funds and you're north of 5%. And some of them even more than that. Money market funds. People want safety for a fair price. Well, if inflation is coming down and money market funds are starting to pay more, now the gap, that spread between inflation and what you get in a money market account, it's not out here. It's here. And so people that don't want to take risks say, good enough. If I can get 5% in a money market account and inflation is going to be 6.1, 6.4%, I'd rather have my money safe than take any risk with it. And I know that's not speaking to everybody, right? Some of you are younger and can afford the risk. I'm talking about those of you that are about to retire, that have spent your life savings in the market. You don't have to anymore. So add that to the fact that we have money moving into the tech area, but money coming out as a whole. Add that to, oh my gosh, is it a soft landing? If so, we've already priced that in. So we don't have that upside juice that we likely would have if it wasn't priced in. So one last thing, money coming out of the market, going over to safety, but there's no money, or there's not as much money in the market as there was. So that's kind of interesting. So a little bit of lessons there. I just wanted to come to you with something where we could, make a lesson out of it, but also be talking about where we stand. We haven't done that in a while. So hope you enjoyed that. And if you did, maybe you'll come back in just a little bit. 7 o'clock Eastern, Jazz After Dark. Tonight, we're going to be talking about 4 retirement planning mistakes we all will or have regretted doing and what you can do about it. So we'll talk about that later. And this applies to long-term savings as well, long-term goal planning, I should say. So hope you'll join us then. You guys enjoy the rest of your day, and we'll see you tomorrow on A Closing Beat, back in the studio there, the old-fashioned way. But what do you think? You like this style a little bit? I do. It's fun because I'm at home. I get to make a class. Anyways, thanks for watching, and hope you'll subscribe, all that good stuff. We'll see you later. Adios.